Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ZIM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.2 billion market cap. They're trading at $10 a share and they have 120 million shares outstanding. ZIM is one of the world's largest container shipping companies. Its fleet is made up of 150 vessels. Of the 150 vessels, 134 are container ships and 16 carry cars. Of the 134 container ships, 120 are chartered and 14 are owned by ZIM. All 16 car carriers are chartered. Let me explain what I mean by chartered. When ZIM charters a vessel, this means another company owns the vessel, but ZIM takes possession of it for a predetermined period. It is similar to leasing a car, but much more complex and costly. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. When ZIM started trading, their stock was red hot. Look at their free cash flow growth, 800 million up to 5 billion in 2021. Even higher in 2022, 5.8 billion. They were paying a massive dividend, but they eliminated their dividend because look at their free cash flow now, 900 million. A decline of 84% from 2022 to 2023. They still have a decent free cash flow margin. In 2023, they converted 18% of their revenue into free cash flow. It was nearly 50% in 21 and 22, but 18% is not a bad number. Each share of stock is around $10. If you take their total free cash flows over shares outstanding, it's $7.51. So it's a pretty high free cash flow per share. And of course in 21 and 22, it was ridiculously high. That's why they were paying a dividend around 100%. Net income is the profit or loss on the income statement. It's revenue minus expenses. The trend is similar, but more severe. Net income was 4.6 billion in 21 and 22, a big negative in 23. Their net income grew 787% from 2020 to 2021, and their margins peaked at 43% in 2021. Revenue is the sales for the company, and that peaked in 22 at 12.6 billion. It is over 5 billion, which is higher than 2020's number. Their revenue has come down 59% from 2022 to 2023. Their revenue per share is really high though. It's still over 40, and each share is only $10. This means they generate a ton of revenue for the size of the company, for the market cap. Their market cap is 1.2 billion. Most companies don't generate more revenue than their market cap, but not ZIM. They generate a lot more revenue than their market cap. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 4.4 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $2.5 billion. We divide that by 120 million shares, and we get a calculated stock price of $21. They're trading at $10, so they're trading at a 52% discount. It's a really strong buy according to the model. Even ZIM's management says 2024 will be a rough year, but they think by 2025 they can get back to profitability. And I gave them a small profit, a small free cash flow in 2025, 400 million. And I grew it up to 666 million by 2027, which is still a lot lower than prior years. But if they do hit these targets, the stock should go up a lot and you should get a nice dividend. Of course, it all depends on shipping rates. If shipping rates keep coming down, then nobody in the shipping company will make money. There are 31 companies in the same industry as ZIM, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 88 million in capex. These are the investments in vessels. They used to spend a lot more. For a while, they were the largest company in this industry. Now they're down to number 8. They're a bit leveraged. Their debt to equity ratio is 2.0. For every dollar of equity, they have $2 of debt. They generate the most free cash flow out of anybody on this list. As I mentioned earlier, they rank 8th in market cap. Kirby is number 1 at 5.7 billion. Then Matson is number 2 at 4 billion. They have a good price to book because companies in this industry tend to have a really solid balance sheet because they have so much fixed assets on their balance sheet, the vessels. We can't look at their PE. They have negative earnings. They have the best price to free cash flow out of anybody on this list. They're trading at 1.3 times free cash flow. The best price to sales out of anybody on this list, a 0.2. That means their revenue is about 5 times their market cap. They generate the most revenue out of anybody on this list. Lots of number ones for this company. But they're still growing. Even though their revenue has come down in the past year, if you look back in the past 5 years, their annual revenue growth rate is 10%. Navios is number 1 at 42%. Euroseas is 41%, but they're a tiny company, 248 million market cap. And Euroseas has the best PE at 2.2. Maybe that's a strong buy. If you put $10,000 into this company when they started trading in 21, you'd still be up today. You'd be at $20,000. That's a 24% annual return. But you would not be happy because at one point your $10,000 would have been about $70,000, and you would have been pissed off if you're down to $20,000. You would have made all your money and then some in dividends though, but still, we're never happy. Let's take a look at their annual financials. We'll start with their income statement. This shows us 2021, 2022, and 2023. You can see their revenue has come down quite a bit, $5.2 billion in 2023. Their revenue is income from voyages. That's mainly their revenue. They also get a little revenue from related services. Here's a breakdown of their revenue. This shows us where their cargo goes. Of the $5.2 billion of revenue, $4 billion is broken out by location. $1.8 billion in the Pacific, meaning their vessel travels through the Pacific. $500 million cross Suez, trips where the vessel goes through the cross Suez Canal. $630 million Atlantic, $620 million intra-Asia, and $400 million in Latin America. Vehicle shipping is $530 million, other revenue $700 million. That's mainly demurrage and value-added services. Demurrage is fees. Let's go back to the income statement. Below revenues, operating expenses $3.9 billion, depreciation $1.4 billion, and lots of impairments. They wrote down the value of a bunch of vessels by $2 billion. So that gives them a gross loss of $2.2 billion. Last year they had big gains, a gross profit of $6.4 billion. Before that, $6.1 billion. So their operating loss is $2.5 billion. They have some financing expenses, $446 million. They had a gain in taxes of $128 million. Last year they paid $1.4 billion in taxes. So their net loss is $2.7 billion. In prior years, it was almost $5 billion. That gives them a loss per share of $22. That's more than double each share price. Let's take a look at their balance sheet. Current assets, $2.6 billion. Current liabilities, $2.5 billion. So their current ratio is a little above 1. Total assets, $8.3 billion. A bulk of their assets are their vessels, $3.8 billion. Last year it was higher, $4.4 billion. But they took a big impairment. That's why it's lower. Containers, $800 million. It looks like they have a bunch of investments, $900 million. Their total liabilities are $6 billion. Their big liabilities, lease liabilities. They lease some of their vessels, so they owe money on those vessels. Another $1.6 billion of lease liabilities. If it's in this section, that means the lease payment is due within 12 months. If it's in this section, the non-current section, the lease payment is due beyond 12 months. Let's take a look at a statement of cash flows. So in 2023, even though they had negative net income, they still had positive operating cash flow of $1 billion. A lot lower than prior years of $6 billion, because that $2 billion impairment is a non-cash item, so we have to add it back here. We also have to add back the depreciation and amortization, $1.5 billion. In their investing section, they had a cash inflow of $1.8 billion. It looks like they sold a lot of investments, $2 billion. They paid for those investments 2 years ago. And 2 years ago, they spent $1 billion in new vessels. In 2023, $115 million. In their financing section, they paid $1.7 billion in lease liabilities. Dividends of $769 million. Last year, $3.3 billion in dividends. That's more than their market cap today. So in their investing section, they had a cash outflow of $2.9 billion. Last year, they had a cash outflow of $5 billion. Let's take a look at their company presentation. For 2023, revenue of $5.2 billion, down 59% from 2022. $1 billion of adjusted EBITDA, that's down 86%. Their adjusted EBITDA margin is 20%. Adjusted EBIT, negative 422 million. Operating cash flow 1 billion, down 83%. 2.7 billion of liquidity, 2.5 billion of equity. 2024 may be a rocky year. There's a supply-demand imbalance. So that's why this company thinks 2025 will be their breakout year. Their projection for 2024 is adjusted EBITDA between 850 million and 1.45 billion. 2023 adjusted EBITDA was 1 billion. Adjusted EBIT, negative 300 million to positive 300 million. 2023, their adjusted EBIT was negative 400 million. They have a modern fleet, 46 new builds. New build is a new vessel as opposed to a refurbished vessel. 28 of those vessels are LNG powered by liquefied natural gas, which is supposed to be more efficient than traditional fuel. In 2025 and beyond, they want a more modern, greener, fuel-efficient fleet, and they want to be a leader in carbon intensity reduction. That's the big buzzword these days. Their 2024 capital allocation priorities: invest in long-term growth and preserve cash. In 2023, they carried 3.3 million TEUs, 20-foot equivalent units. That's what most of their vessels carry, 20-foot containers. How many 20-foot containers can you fit on a ship? Because inside those containers is what they deliver for their customers. So in all of 2023, they delivered 3.3 million TEUs. That's down 3% from 2022. So it's not down too much. It's just shipping rates have come down so much. That's why revenue has come down. In Q4, they carried 786,000 TEUs. But the big decrease is freight rates. The rates they charge their customers. That's down 63%. They charge $1,200 per TEU. It was a lot higher in 2021 and also 2022. Revenue 5.2 billion, down 59%. For Q4, 1.2 billion, down 45% from Q4 2022. Free cash flow 900 million. Cash conversion rate 88%. That's up 11%, down 41% for Q4 2023. The cash conversion rate is the amount of days it takes a company to convert its inventory into cash. They have 5 billion of debt, which is up 666 million. 2.7 billion of cash, down 2 billion. Net debt 2.3 billion. Their net leverage ratio is 2.2. Usually a good net leverage ratio is below 1. Hopefully they can pay off their debts and remain a going entity, not go bankrupt. Here's the 150 vessels I mentioned in the beginning of the video. And they measure vessels by how many TEUs a vessel can fit. They have 10 really big vessels that can fit 15,000 TEUs, 20-foot equivalent units, those big containers. Their most popular vessel is the 8,000 TEU, and that's LNG fueled. They have 18 of those. So of the 150 vessels in their portfolio, 134 are container ships. They carry these big containers. 16 carry cars, because they transport cars from one location to another. Most of their vessels are chartered, which means they don't own them. Of these 134 container ships, only 14 are owned by ZIM, the rest are chartered, which means another company owns them, and ZIM leases those ships. Here's a visual of their financials. You can see their revenue is down for the quarter 45%. For the year, it's down 59%. There's the 5.2 billion for 2023. Everything is down quite a bit. Adjusted EBITDA is down 86%. It was 7.5 billion. Now it's a little over 1 billion. They shipped a similar amount of product as they did in 2022. It's just shipping rates have come down a lot. That's why their revenue is lower. They shipped 1.3 million containers in the Pacific. The second biggest is intra-Asia, 900,000 containers. Pretty similar to 2022. So it looks like 2024, they expect similar results as 2023. They do say freight rates will be slightly higher, volume will be higher, and bunker costs will be lower. Here's a chart of supply and demand. This red line is the volume of product, global throughput growth. That's projected to grow a little bit, 3% in 2024 and 2.5% in 2025. But fleet capacity really needs to decline. There needs to be less and less ships in the market. That's the only way rates will go up. If shipping companies keep getting new ships, then rates will never come down. But if a bunch of companies go bankrupt in this industry and they have to scrap some of their ships or sell them at a discount, that could benefit companies like this. They can get ships at a cheaper rate and hopefully shipping rates start to go up. ZIM is saying 23 and 24 is a transition period. 2025 and beyond, they expect significant improvement in their market position. Only time will tell. Let's take a look at the stock on Simply Wall Street. Its last price $10, 1.2 billion market cap. It's up 5.5% in the past week, but down a lot, down 59% in the past year. Let's see what they say about the company. ZIM provides container shipping and related services in Israel and around the world. They provide door-to-door and port-to-port transportation services for various types of customers, including end users, consolidators, and freight forwarders. They also offer ZIM Monitor, a premium reefer cargo tracking service. Reefer is not marijuana, it's refrigerated products. This is when they ship goods that need to be temperature controlled. As of 2024, it operated 150 vessels, which included 134 container vessels and 16 vehicle transport vessels. It operates a network of 67 weekly lines, which means it goes to 67 different locations. They were incorporated in 1945, headquartered in Israel. Here's their historical stock price. They IPO'd at $15 in February 2021, and there was so much hype on this stock, lots of buying activity. The stock got up to $88 in 2022. But ever since then, it's been coming down a lot. It went from 88 in March 2022 to 20 in March 2023. And then it bottomed out around 650 in November 2023. Over the next 6 or so weeks, the stock did double. It hit about $15 in the beginning of 2024, but it's down about 40% from that point. It looks like it could be a good time to buy the stock. Simply Wall Street's valuation is 23. They say the stock is 56% undervalued. 7 analysts priced this stock at $9.68. They say it's a little overvalued. Their revenue target for 2024 is $5.7 billion, 2025 $5.3 billion, and 2026 $5.7 billion. Their free cash flow target for 2024 is $450 million, 2025 $400 million. Their revenue back in 2013 was only $3.7 billion. And for the next 7 or 8 years, it was pretty steady. It didn't really move too much. Then when shipping rates went up, their revenue skyrocketed to almost $14 billion. It has come down a lot, but it's still a good amount higher than pre-2021 levels. They had $2.1 billion of debt in 2013. It looks like they've been lowering their debt quite a bit. They're down to $121 million. And according to Simply Wall Street, their equity is a lot higher than their debt, which is different than the chart we looked at earlier. And they have a lot of cash on their balance sheet, a lot more than their debt. They offered a 16.5% dividend yield in December 2021, raised it to 63% the next quarter, March 2022. By the end of 2022, it was still over 60%. By April 2023, even higher, 87%. That's why so many people were jumping into this stock. But what goes up must come down, and it came way down to 3% by the end of 2024. Now it's 0. 56% of the companies owned by the general public, only 22% by institutions, 21% by private companies, and 1% by insiders. The biggest shareholders, Court Investments, then Menorah Pensions, then finally a name I'm familiar with, BlackRock, Morgan Stanley, the CEO, Goldman Sachs. Here are some big companies, B of A, Jefferies, Stichting, the Dutch pension fund. Their employee count was 3,800 in 2020. Now it's 4,800. And the ticker trades on the Deutsche Börse and New York Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.